Okay, so what we did last time, we talked about two different things you'd use to determine what kind of investment you've got, right? Which category they're going to go in. What are those two things? How long you're going to hold something, right? Okay, so one is how long. And what's the other one? How much? How much you own, right? So those are the two questions you'd ask yourself. How long am I going to hold it, and how much do I have? So let's do how much first. We split into three categories, don't we? You know what they were? Okay, one share through 20%. Okay, now here we're talking about common stock, where it's voting. If it's non-voting, well, there is such a thing as non-voting common stock, by the way. If it's non-voting common or non-voting preferred, or if it's an investment in bonds where I'm not holding it to maturity, all of those are going to fit in this category, right? Even if I've owned all the preferred stock. Why? They don't vote. So how much control do you have if you get one share up to 20%? How much control do you have? When you vote, you lose. How much control? No control. Come on, you guys, wake up. Okay? I need your enthusiasm today. This cold's got me down. Come on. Okay? So no control, right? Okay? So what method of accounting are we going to use? We're taking what the market gives us, right? Because we're not controlling it. Market value method. Okay, there we go. All right. Now, that's one share to 20%. What's the next category we have? Obviously 20%. Up to what? 50. 50. What do we have there, gang? We say we have significant influence. I am no longer taking what the market gives me. I am helping run the company. That's the theory. And if you get that theory, then the accounting's easy. If you don't, it just seems like, what are they doing? Right? When you read this chapter, was it nice that we'd already gone over it? Kind of, in this one, huh? And it's like, wow, what are they doing? Where are they going? The other thing, the authors name different things with the same account name. Drives me crazy. You know, so you're like, wait a minute, they told me it's something different, they're using the same account name. Let's use different ones, which is what happens in real life. This is a relatively new area of accounting. There's been a lot of changes in this area, so last few years, right? So the authors don't quite have the terminology down yet because people are evolving the terminology. Does that make sense? So we'll use terminology that's a little more mainstream. That is, okay? All right. So we have significant influence, and therefore we are not going to take what the market gives us. We are going to help run the company, so we think we have a what? Equity interest in this company. We get to run our share of it, our equity in it. So what do we call that method? Equity method. That's it. Method. Excellent. Okay. And then obviously, over 50% up to what? 100%. What do we think we have here? When we vote, we win. What do you say? Control. Do you really have to remember these, or are they just common sense? Yeah, if you know what the deal is, it's just common sense. And here, you don't have to use the market value method. You don't have to use the equity method. You can just leave it at cost, which paid for the stock in the first place. Leave it at cost, historical cost. And that's it. Because we're going to eliminate everything anyway. Right? We're going to use an elimination entry, and we are going to eliminate the company that we have the investment in. What do we call this company, by the way? What is it? A what? It's a subsidiary. This is going to be an investment in a subsidiary. So I'd call it investment in ABC company subsidiary, or investment in XYZ company subsidiary. Got the idea? or investment in subsidiary dash XYZ company, that kind of thing. Okay? All right? And what we're going to do here is we're going to combine all the companies together, and we are going to call that what method? Consolidation. You got it. That's consolidation. Okay. Now those are subsidiaries because we own more than 50%. What if you own between 20 and 50%, but you have significant influence? We call it an investment in a what? Affiliate. It's an affiliated company. You got the idea? So when you talk about an affiliate, that's what you're talking about. Okay, investment in affiliates. These are going to be an affiliate. Excellent.
So what'd you say is an affiliate when it's 20, 50%?
20 to 50%. Significant influence is an affiliate, right? Affiliated company. Okay, so you've heard of affiliates, right? You've heard of subsidiaries, haven't you? So that's what these are. Okay, it's just business terminology. You know, it's really funny. Everybody says, "Well, there's so much to learn in accounting." Well, not really. Left and right, debits and credits, and everything else is just business, right? But boy, business gets complex. Okay, now where's the how long apply? That's on what? Just the no control scenario, right? Just over here on the no control. There are three categories on this one, right? For how long you're going to hold it. What are they? 1 day up to a few weeks, maybe. Very short period of time. You might get some debate over exactly how long that is. What did the author say? Did it say a few weeks too, or just real short? A few weeks. Okay. All right. 1 day to a few weeks. What do we call these? What's the name for those? I'm going to hold, that's how long I'm going to hold it, right? About the stock for 1 day to a few weeks. 1 day I'm just parking the money for it, earn something on it maybe. What is the deal? What do we call that?
Trading.
Trading security. Excellent. So it's an investment in trading securities. Good. All right, so you got that one. Okay, what's the next one? Over a few weeks up to what? 1 year. This one's easy. What are you going to call it? Investment in available for sale, short term. It's short term because it's less than a year, right? It's the definition of short term. Okay, and then what's the natural other one? Over 1 year. Now, if it's a bond and I'm going to hold it to maturity, I record that as an investment held to maturity bond, have a discount or a premium and amortize it, right, guys? Did that last chapter. Okay, this is if you're going to hold it for less than to maturity for a bond. If it's preferred stock, but I'm going to hold it more than a year. If it's common stock where I own less than 20%, right, I'm going to hold it for more than a year. Up to forever. Got the idea? Okay, so what is this going to be? Available for sale, investment available for sale, what?
Long term.
Why did I put AFF instead of AFS? All right. Available for sale, short term, and available for sale, long term. Okay, investment in available for sale, short term. Investment in available for sale, long term. We already did these, right? Okay. All right. Under the market method, because we're taking what the market gives us, what do we do? What do you do, gang? You're taking what the market's going to give you. So how do you handle these three things? Okay. We know how we're going to record them when we buy them, right? If I own less than 20%, then I'm going to hold it for a few days, or a day, I guess, up to a few weeks. I'm going to debit investment in trading securities. I'm going to hold it for up to a year, more than a few weeks, up to a year. Debit investment in available for sale short term. I'm going to hold it for more than a year. Available for sale long term, right? What if I own between 20 and 50%? I'm going to debit what? Investment affiliate, probably with the company name. Investment affiliate XYZ company. Okay. What if I buy more than 50% of it? Debit investment subsidiary dash XYZ company. All right, guys? So we know all of that. Well, then how do we handle them reporting net income or net loss, right? What do you do? What do you do if you're, so we want to know that for each one of these going across, right? And then we want to know how you're going to handle dividends, okay? And we want to know how you're going to handle increases and decreases in the market value at the end of the year, okay? Now the first one we said is mark to market, right? Market value method, mark to market. I'm going to adjust it to market. Mark to market, people will call that. Okay, what are you going to do? What are you going to do with net income or net loss if I'm just taking what the market gives me? What would I do in this category over here on all three of these? What would I do? No entry, right? No entry here. Why not? Because I'm not making the income happen, right? Somebody else is running the company. I'm just taking what the market gives me. Okay, everybody good? We did that last time. What do you want to do with dividends? They paid me a dividend, right? I'm taking what the market gave me. The market gave me a dividend. So I'll debit cash and credit what? Dividend revenue. Very good, guys. That's it. Okay? And the reason is I'm earning dividends, right? I invest in the market, I'm earning dividends. What would I do with the increase or decrease in market value? It's going to be a what? Unrealized gain or loss, right? If it's a gain, what does that mean? The stock went up in value, right? I would debit investment in trading securities and credit unrealized gain, right? If it went up in value on trading securities. Where does that unrealized gain go on trading securities? So a little difference here. Where does it go?
Equity.
It goes to equity through what, though?
Other comprehensive income.
No, that's the available for sale.
Oh,
Going
no,
back.
that's right.
Okay, and the trading securities, right? Because it's very short term and we think the price isn't going to go up or down before we sell it. That's the idea. It's real short term, right? So in the next few days, we think it won't change. So we don't go to other comprehensive income. We go ahead and put it on the income statement. The available for sale ones, we think the price will change anyway before we sell it. It might recover. That's the theory, right? Really, people don't want to show the gains and losses on their income statement. But yeah, that makes sense. The theory does make sense. Okay, so where does the one go if it's an unrealized gain? Where does it go if it's an unrealized gain on trading securities? That's going to go in the income statement, right? You were going to show on the income statement, revenues less cost of goods sold is gross profit, right? Less all the operating expenses is operating income. And then you have a section for non-operating income, gains, losses on selling assets perhaps, right? Gains and losses. These unrealized gains and losses that go there, other revenue, other expense items would go there. Right, guys? Remember that income statement? Okay. All this stuff's going to be on the final, right? You don't have to have it right on the, right there, right now. But when we get to final, we got a week to get ready for it, don't we? When you get there, you need to go recover all that stuff, right? The first few exams. I mentioned the other class. Isn't it going to be really cool when I give you something like, the company bought land with cash for $100,000. Give me the journal entry. Is there anybody sitting here who could not do that? I'm going to actually give you points, just like the points I'm going to give you for this stuff, right? It's knowledge you acquired in this class, right? Didn't know how to do that before you got here, probably, right? So pretty cool, huh? It always amazes me when students say they don't want a comprehensive exam. Are they crazy? All the easy stuff's at the beginning. Why would you not want comprehensive? What if I gave you a final just on this last couple of chapters? Oh man, that'd be awful, right? Ugly. Okay, anyway, so it all accumulates. All right, anyway, well, what if it's a loss, by the way? Well, you'll have to credit the investment in trading securities and debit unrealized loss, right? Why is it unrealized? Because we haven't sold it yet, there's no cash out. And realization is the cash changes hands, okay? But it's still going to be recognized on the income statement. What about those gains and losses if it's on, instead of trading securities, if it's on available for sale, short-term or long-term, either one? Where do those go now? Other comprehensive income. You got it. That's it. They hit other comprehensive income. That's an equity account. You don't close it, right? It never ends up in retained earnings. When would, by the way, the change in market value hit retained earnings on those? When you sell it, and it's a realized gain or loss, right? That's it. Okay? So the accounting for it gets kind of hairy. Okay? You have to get rid of the unrealized gain or loss in the other comprehensive income account. You do that. Okay, good. All right, so what do you think happens then with that? That's the net income, right? No entry. That's the dividends. Or I'm sorry, that's the unrealized gain or loss. What if I did dividends, didn't I? I'm sorry. Brain is fried already. Gotta get through a night class too somehow. All right, anyway, we did all three, didn't we? Net income, net loss, dividends, and did I do dividend revenue? Okay, and change in market value. Let's think about the same thing in an affiliate. Now in the affiliate, we're making the income happen. So what do you think would happen here on the affiliate? We're using this equity method. Our share of the earnings we're going to record as earnings for us. So what are you going to do with the net income or net loss? I earned a portion of it. So my percent, I am going to put in my net income. My percent will increase my net income, and it'll also increase my investment in affiliate. I think I have more investment because I earned, and I think I earned my share of the income. And we'll do an example of that. But look how different it is between significant influence here and no control over here, right? How about on the dividends? I'm not taking what the market gives me. My income comes from earning, right? From running the company, from their net income. So what do I do if I pay myself a dividend? You can't have income from the net income and then have income from the dividend too. That wouldn't make any sense whatsoever, right? What's really happening with the dividend? I decided to pay myself a dividend. I voted my share of the stock, right? And I own more than 20%. I have significant influence. I voted to give myself a dividend. Everybody good with that? So what I do is with the dividend, my percent of the dividend, of course, is what I'm going to get. I am going to reduce my investment. Right? So as the company earns, I think the investment's worth more. As the company pays me a dividend, I paid it to myself. I think I took out some of my investment. Okay, so we'll look at that. And then what about this change in market value? If it goes up in value, I think that's nice. If it goes down in value, I feel bad. But in any case, I'm not selling the stock anyway. I own more than 20% of the company, right? I bought it to help run the company. So no entry. Got the theory? And this is a theoretical construct, isn't it? Based on whether I have control or not. Got it? Okay? And you're going to like this for subsidiary. We don't have to record any of it, because we're going to eliminate it all anyway. Okay? What we're going to do over here is all we're going to do is an elimination entry. And we'll talk about what we're going to eliminate. Okay? It's going to be the investment in the subsidiary. And it's going to be all the equity of the subsidiary. Because the subsidiary doesn't exist. The parent owns them and controls them. Okay, so let's do this affiliate method here, right? Let's do where we have significant influence, right? Equity method affiliate. All right, so what was our example like last time? We did the same one in both classes last time. And I have XYZ company or something. We had 1 million shares. I know what it was. And the market value at the time of purchase was $10. And I think I changed it to $11. It could go up or down, obviously. Market value year end. Only this time, we're going to buy more than 20% of the stock. Last time we only bought, what, 1/10 of a percent? About 1,000 shares out of 1 million? 1/10 of 1%, so we certainly have no control.
Is that SL?
Shares.
Oh.
Still can't read it. Okay, shares. Okay. All right. So 1 million shares. $10 market value at the time of purchase. Okay. And then $11 market value at year end. Okay. And let's say that we buy 300,000. That's 30%, right? Shares. So that's our purchase. Everybody good? Okay. I'd like you to give me the journal entries then at the date of the purchase. Let's say that's January 10th of the year, right? That's where the purchase is. And let's say we paid cash. You probably would, right? Investing in stock. Okay, and then at January 31st, I'd like to get the entries for the change in market value. Oh, I didn't give you one of the things. We had two of the things. Net income was how much? 250,000, was it? Wasn't it? And then dividends, I gave you 100,000. So just using the same example. Okay? Whatever they are, no problem. So I want you to do the change in market value for me. You can see the market value went up by $1. I'd like you to do the net income for me. And I'd like you to do the dividend for me. So for any of these, I'm going to ask you to record the purchase and then record change in market value, right? Do whatever you need to do. Net income and dividend. Could you do these? Well, let's do the purchase first. What do we buy? 300,000 shares. What do we pay? $10 a share of cash. How much is that? 30 million bucks. No, $3 million. $3 million. Is that right? Debit what? Investment in, now I own 30%, right? So what do we say? Investment in affiliate, because I have significant influence. XYZ company. Very good. For $3 million? Credit what, everybody? Cash. That part we can do, can't we? Don't anybody on quizzes, tests, and final miss debits and credits to cash, no matter how complex things get, right? Don't screw that up. We get flustered. Not do it. All right, good. So we're set. Change in market value. I'm not just taking what the market gives me. I've now helped to run this company. I run 30% of the company. So what's the entry here? No entry. None. Don't just leave it blank. If I put it down there, put something next to it, right? No entry. Okay? We don't do anything. Okay. Good. Net income? My net income. What's my share of the net income? 30%. So I have 30% of the income and 30% of the dividend. You guys agree with that? If they made $250,000, what's my share of it? 30%, 75,000. Is that right? Mine's 75,000. What do I want to do? I want to increase my investment from the $3 million I already have invested. I want to increase it by 75,000, my share. Got the idea? So debit investment in affiliate XYZ for the $75,000. That's my share of their income. Credit what? Equity interest in earnings of affiliate. Did the authors use something like that? It's some god awful term, isn't it?
Equity and affiliate earnings.
Equity affiliate earnings. Mine was even worse. I've seen mine too. You can call it income from affiliate or equity interest in affiliate earnings, right? Whatever you want. Okay, so income from affiliate. This is a new area of accounting, fairly new, and so people have all kinds of different terms for these things. So income from affiliate. This is going to go in that non-operating section of my income statement, right? Income from affiliate, my share of their earnings. Got it? Which I'll, of course, close to my retained earnings. Okay? So that's it. Increase my investment by my share of their earnings, right? And increase my retained earnings by my share of the earnings by running it through my income statement. Got it? Yes.
So this extra investment in affiliate, we can do that because it's theoretically we're not going to sell the company.
You got it. We don't intend to sell it. So we do care what the market value is, but you know what? If we went out and started selling all this stock, the market value would go way down anyway.
Yeah.
We can't get that market value. So we think the real value of this, and the market's going up and down and up and down, we think the real value change is due to our earning. Make sense? That's the theory behind it.
But if somebody bought us, they would still get it because we own them, so right?
Well, if somebody bought us and they bought us and they buy all our investments, they now own this investment. And they'd still own 30% of the company, right? Yeah. So they still account for it the same way. What's interesting is when you go from one category to the other, how about if you, you own less than 20%, you're down here, and then you buy some more and you go up in here. Now you have to switch from one method of accounting to the other. It's a real pain. Or if you're in the significant influence and you go on up into control, you have to switch to a consolidation. So it makes it more hairy. I won't do that kind of stuff, you guys. Not at this point. Okay, but that's a good question. Yeah, the theory is that I'm not taking what the market gives me. I'm making it happen myself. Right? Okay, let's try dividend. I bet I get something. I vote to give myself a dividend. What do I give myself? Cash. How much cash? 30% of the 100,000 would be 30,000, wouldn't you guys? Everybody agreeing with me on this? And what do you want to credit? It's not dividend revenue. I already recorded income of 75. I don't want to record it again, right? Does that make sense, everybody? What is it? I decided to pay myself back some of my investment. So credit what? Investment in affiliate XYZ. The way to look at this, 30,000. Way to look at this is to look at what's happening to the retained earnings of the affiliate. This is on the affiliate's books, right? On the affiliate's books, what happens to their retained earnings? And then what happens to the investment in affiliate on the investor's books, right? The company that has that holds the investment. Okay, what did we start out with investment in? And by the way, this would be some big number, whatever their retained earnings are, right? For the affiliate. What's my first entry to the investment in affiliate? 3 million debit, right? Then what happens? What happens when they report net income on the affiliate's books? They close their revenues and expenses to income summary, and then close that to retained earnings, don't they? So how much would they increase retained earnings because they had a net income of 250,000? They'd increase it by 250, wouldn't they? And when they did that, what would we do to our investment in the affiliate? We would increase our investment in the affiliate by our 30% share, or 75,000. Everybody see that? So as this goes up, the retained earnings goes up, ours goes up by the proportionate share. Okay? We're just tracking right with it. Because we think if they become more valuable, our investment's more valuable, huh? Probably true. Okay? And then when they pay a dividend, what do? What they do with that 100,000 dividend? They take it out of their retained earnings, wouldn't they? So the net increase in their retained earnings is 150,000 for this year. Would you guys agree with that? You know, they earned 250 and they paid a dividend of 100, right? What would we do with that dividend? We would reduce the investment by how much? 30,000, which is our 30% of the 100 that they reduce retained earnings by. So what's the net change here? These two, $45,000 increase in our investment to match 150 times 30%. See it? So as they change their retained earnings, we change our investment by exactly the same amount. Okay? By our percentage share. Does that make sense? Help a little maybe? Okay, keep it straight. Okay. Questions? Working? Okay. Well then what do we have left, everybody? That's it, by the way. That's it. Okay. What do we have left? An elimination journal entry. That's not in the book. What they did in the book was they bought the other company and they merged it in and eliminated the other company, which is great. Read that, look at it, right? It happens a lot. A company will buy another company and they just eliminate the stock of the other company, right? The other company ceases to exist. They merge all their assets together, all their liabilities together, and right, the other company's gone. Okay, you can do that. And you can have goodwill from that purchase too, okay, because you paid more than the fair market value of the assets less the fair market value of the liabilities. What I'm talking about here for a consolidation is where we buy the stock but we don't close the other company. So you might have a parent, maybe Young Brands, owns 100 other companies. I don't know how many they own, but large companies own lots of other companies, right? So what if they own 100 other companies? What you end up doing is adding all the companies together, the parent and the 100 subsidiaries. So imagine a spreadsheet with 206 columns on it, right? In the Excel or something. Of course, they don't really do it that way, but they do a number of spreadsheets and keep consolidating them down. But let's say we got one with easier to envision. Let's say we've got 206 columns. First two columns are the parent, debits and credits, all their accounts, assets, liabilities, equity, revenue, expense, everything totaled up, all their general ledger, right? Then you have two columns for each one of the subsidiaries, all their assets, liabilities, equity, revenue, expense. So we're going to add up the cash for all the companies, the land for all the companies, the long-term debt for all the companies. Got the idea? Okay, we're going to add everything up. Okay? And then at the end, we have two columns that are for what's called an elimination entry. So whose books are these on? Seeing as if there's 100 subsidiaries, there's 101 companies, including the parent, right? Whose books did this elimination entry go on? No one's. We don't post it on anybody's, right? You couldn't, because some of the accounts are coming from the subsidiary and some of the accounts are coming from the parent. Got the idea? Okay? So this elimination entry is only on the worksheet. The last two columns of the worksheet is going to be where we add everything together, less the elimination entry. Now, in real life, what happens, of course, is you'll have to eliminate all intercompany revenues and expenses. I'm doing business with myself, right? The parent's doing business with the subsidiaries. Maybe different subsidiaries are doing business with each other. Anything they sell to each other is a sell to yourself. Anything you buy from each other is you purchase it from yourself. Any profit that's left in inventory, like one sold at a profit to another one, that has to be eliminated because it didn't really happen. If you loan money to each other, is a receivable payable? Didn't happen. If there's an account receivable and account payable, it's an account receivable from yourself and a payable to yourself. It doesn't really exist. So this consolidation is really a big job. I mentioned that to you last time. In accounting 414, we'll spend half the class doing this stuff, right? How do you get all this stuff eliminated? In here, what we're going to do is just the elimination entry on the date of the acquisition, the date you purchased it, to give you an idea of how this thing works, okay? What goes on, to make the point. If I just talk about it, it's kind of like, oh, well, that's nice. But if you actually do it yourself a little bit, so you get a grasp on it, every financial statement you look at for large corporations is going to be a consolidated financial statement. If you look at the sample financial statements they give you in there, the example in the appendix, it says consolidated, right? Parent company and subsidiaries, right? Okay, so any major company is going to be like that. Now here's the good news again. You don't have to worry about any of these things here. You don't have to worry about how you handle net income, dividends, or changes in market value, because you don't. You don't record them at all. You'd have to eliminate them anyway if you did. If you wanted, you could use this equity method over here on your subsidiaries. Some companies do. But you'd have to eliminate all that activity then if you did. Okay? So let's try an elimination journal entry. Let's see how that works. Okay? Here we go. Let's go for the same company. Okay? So XYZ company. That's a Y, isn't it? Really? Let's say they have 1 million, 1 million shares of common stock. That's outstanding, right guys? Okay. And this time, let's say we purchase 80% stock. Okay? We're going to buy 80%. What do you think we're going to have? Control or what? Absolutely, right? Listen, our share is going to be 80%. What's the minority share going to be? We're going to suddenly have a minority interest we have to worry about. They're 20%. Everybody agree minority interest would be 20%? Just like that. Nothing, right? Okay. All right. And let's say the market value at the time of the purchase is $10. It's $11 at the end of the year, but so what, right? We're not going to do anything with that, right? No entry for that. Everybody agree with that? How about if the net income is $250,000 again? What are we going to do with that? Nothing. No entry. You're liking this, aren't you? Right? What are we going to do with dividend? Let's say they paid a dividend of $100,000. Just make it the same example as the other one was. What do you think? No entry. Everybody agree? You don't have to worry about it. What do we have to worry about, though? Well, of course, you have to record the purchase. So whose books are the purchase is the purchase going to go on? On the parents' books, right? Whoever the parent is, Young Brands, whoever it is, okay? What are we going to do? They're going to buy stock, and they're going to buy it with cash, say. How many shares are they getting? There's a million shares, they're buying 80% of the company. How many shares are they getting? 800,000. What are they paying per share? $10. What are they giving them? 8 million of what? Cash. You guys won't miss this, will you? It's the same for all of them, and for all the investments. It's just a different name of the investment. What are we going to call this investment? Seeing as we have control, it's an investment in what? In subsidiary. You got it. Investment in subsidiary. INV there. Okay? And put the name probably. XYZ company, you like it? I don't know why I suddenly can't write XY either. XYZ Co. So something like that. Investment in subsidiary, XYZ company. Good. Investment in, that was just in. Brain is not working. Investment in subsidiary, XYZ company. Okay, credit cash. Everybody good? All right. So now we're not going to do anything with what they reported during the year. Doesn't matter. What we are going to do is an elimination entry, but whose books is that on? Nobody's. Just on the worksheet. Okay? To get the combined financial statements. There is no general ledger that matches consolidated statements, right? It's just a worksheet to put all the general ledgers together for all the companies. Okay, good. So what do we want to eliminate? Well, I think I want to eliminate this investment, don't you? Otherwise, it's an investment in myself in the consolidated companies. Got the idea? So I'm going to want to eliminate that. It's got a debit balance. How are you going to eliminate it? With a credit. So right at the beginning, you could credit investment in subsidiaries. And we do this for all the subs, right? All the subsidiaries. X, Y, Z. Okay? For $8 million. It has to go away. What are we eliminating, though? What do we own? The equity of the subsidiary. We really own 80% of their assets and 80% of their liabilities. Minority shareholders own 20% of each, right? But what represents the net assets? Assets less liabilities. It's the equity, right? We own 80% of the equity. So what we'll do is we'll eliminate their equity. So here's the subsidiaries' equity accounts. Let's just have a couple of them. Okay? So let's say the sub's equity consists of common stock, which is $1 million. Additional paid-in capital on common stock, $1,500,000. And retained earnings, $4 million. What's their total equity? $6,500,000. Is that what that is? You guys with me? That's right, isn't it? Okay. Everybody agree? What did we buy of it? We paid $8 million for what? What did we pay $8 million for? Their net assets are $6.5 million. All their assets less all their liabilities equal their equity. Their equity equals $6.5 million, right? So what do you think we bought? 80% of it. What's 80% of $6,500,000? Our share. Equity. How much is it for our share? What's 6.5 million times 80%? How much?
5,200,000.
Okay. How much did we pay for it? $8 million. Why would we do that? Because we think some of their assets are worth more than their book value. And it could be we think some of their liabilities are worth less. We'll worry about that much later. Okay, upper division classes. Liabilities aren't necessarily worth their book value either. You already kind of know it because bonds change value when interest rates change. Interest rates go up. Bond rate doesn't change. Guess what happens to it? It goes down in value. So, you could have gains and losses on the bonds, couldn't you? Right? That's what we're talking about here. But anyway, so I've got $2.8 million to worry about there. What could that be for? I might have some assets where the market value is higher than the book value, huh? So let's say I just have one. In my problem, I'll probably just give you one. Land, let's say land is on the books at $800,000, and the market value is $900,000. Let's say that was the case. What needs to happen to land? For the consolidated statements, you want to show it at market value. And here's the deal. The parent is buying the subsidiaries so you can revalue the subsidiaries' assets and liabilities. You don't revalue the parent because you don't have any basis for measuring that because nobody bought them. That's the theory. Okay? So if you think land should be is worth $100,000 more than the book value, in consolidation you want to show that. So what do we need to do to land, you guys? Increase it by how much? Just 100,000. Oh, wait a minute. What does that leave me? I've got $5.2 million. I've got 100,000 for the land, right? But we said it was 8 million compared to 5.2 million. That's not enough. That's only 5.3 million. What else do I need? What's the other piece, do you think, to make up the whole 8 million? You bought goodwill. You got it. Goodwill is the portion you were willing to pay in excess of the fair market value of all the assets and the fair market value of all the liabilities you obtained, right? Why would you do that? At my favorite restaurant, if I was buying my favorite restaurant instead of one I don't like, I thought I'd pay a higher price. Why? They have a great chef, customer loyalty, good reputation. You got the idea? Their staff knows what they're doing, right? Good relationships with their vendors, good relationships with the government, you know, the whole thing. So a profitable business, would you pay more for that than one that's losing money? Sure you would. What are you buying? Goodwill, we call that. When can you measure goodwill? When you buy it. So here's the deal. You gave them $8 million, right, for equity that is only $5.2 million, and an increase in land, right, of 100. So that's 5.3. What must goodwill be? 2.7 million? So it was big in this one, wasn't it? Those must total the $8 million. So how's that going to work? What do you want to eliminate? Yes, sir.
Goodwill, isn't that just subjective based on,
Yeah.
so how do,
Well, the way this worked, if the stock was selling for $10 and you thought that was a good price and you're willing to pay the 10 to get it, right? If you negotiated the 10 even, you must think the company is worth $8 million. 80% of the company is worth $8 million. So you think the whole company's worth $10 million, don't you? You got 80% of it. Yes, it's subjective, but you agreed to it. You actually gave them real cash, $8 million. And the $8 million only represents how much equity? $5.2 million. So what'd you buy for the $2.8 million excess? What'd you buy for the $2.8 million excess? The change in the market value of the land plus what? Goodwill. The rest it's the plug. It's the difference. I can't identify what it is. It must be goodwill. Remember, you can't own your employees. You can't own your vendors. You can't own your customers, right? You can't own your government relationships. You can't own your relationship with the community, what the community thinks of you, right? You remember that company where the guy, I think it was $70,000 was the number he picked. He thought all of his employees should make a minimum of $70,000. Made a big splash in the financial press. Young guy, in his mid-20s. And he's a millionaire already, right? And he's got a company that's just taken off at high-tech something. Anyway, he says, this is crazy. I've got people that are working for me for $10 an hour. I don't think anybody that works for my company, when I have this kind of money, should make less than $70,000 a year. And he raised everybody that works for the company's salary to a minimum of $70,000, and took a low salary himself as a result of that. You know what happened to him? That was a year ago. They just reported their earnings, and their sales were something like 5 times as much as they'd been the year before, and his profits were doubled because he paid his employees so much. Now, he got good press for it, so everybody wanted to do business with him, right? An interesting follow-on story. Costco is growing really, really fast. They have really happy employees. I have a Costco card and I never go there. My wife doesn't either, but occasionally. Okay. They sell huge lots of stuff. I don't know what I do with, 20 pounds of stuff, fruit or something, geez. So I like fruit and all, but anyway, they have really good stuff. Their CEO refuses to take more money because he thinks that he's already grossly overpaid. He's over $500,000 a year. But for a company the size of theirs, he could easily be making $3-4 million a year. He just thinks it's wrong. Instead, he pays his people better. So if you're going to work at Walmart or at Costco, where would you rather work? Costco, of course. So are they happier? Yes. They don't just have that. They have health insurance, vacations, all kinds of stuff, right? Because they share the wealth. Which company do you think will be long-term more successful? And I know you guys think, oh, Walmart could never go broke. Do you guys know who Ward's is? Montgomery Ward's. How many of you know who Montgomery Ward's is? Have any of you ever been in one of their stores? Of course not. Do you know who Sears is? Sears is still surviving. Sears used to be the biggest company in the world. Now it's Walmart, retail in the world. Walmart destroyed them, and somebody will take down Walmart too. Maybe Costco. I wish Costco would go in normal stores instead of those big box only things. But I'll shop at a Costco, right? I'll even buy their stupid membership thing. I hate those membership things, right? I'll even do that. Just as a protest statement, if nothing else, right? Plus their stuff is so much better, right? Well, it really is. It's far better. But you want 20 pounds of strawberries? I was. I was making jam or something. I don't know how to make jam. So anyway, yeah. My daughter, though, has a family of 5, and she buys 20 pounds of everything. Right? Kids are starting to grow. Okay, anyways, let's do this elimination entry and get out of here. It's easy. What do we say the percent was for the minority shareholders? If we get 5,200,000 because we have 80% of it, what is 20% of it? That's the minority interest, isn't it? Oh, the minority interest is 20%, which is how much? 1,300,000? So what's 1,300,000 for the minority shareholders plus 5,200,000 for us? It's the whole 6.5 million, right? So what I want to do is I want to eliminate the common stock, the additional paid-in capital, and the retained earnings. How would you eliminate it, seeing as they're all credit balances? With debits. Excellent. How would you eliminate the additional paid-in capital, of course? Same thing, right? How would you eliminate all the retained earnings, of course? Because I control the company. I don't want it to have any of that stuff right on my combined books. I don't want to have any of it there. Everybody agree to that? And then what do we want to revalue? Land. What do we want land to go up to? We wanted to raise it to 900,000 from 800,000, which is 100,000 debit, right? Only in consolidation, only in that worksheet. Does my journal entry balance? No. What am I missing? Goodwill. Well, we calculated goodwill. It's an asset, right? Intangible asset. How much is that? 2,000,007. This is kind of magic, isn't it? That's sort of the plug. What's left, huh? There's one other piece. What is it? The minority interest. And what the minority interest is the equity that the parent does not own, huh? It's not a liability. It's not equity. It's sort of in between. What we'll do is we'll list all the liabilities, get total liabilities, and then we'll skip some space and then have equity down below for the parent, right? Consolidated company. Then you have minority interest on a line. And the minority interest is how much, everybody? 1,300,000. Does that journal entry balance? Wow, it's a big one, isn't it? I think it does. Got it? So goodwill's kind of the plug there. We could have done the entry and not done this little sheet over here, this little spreadsheet. Could have just done the entry and the amount that's left is goodwill. So work on it, guys. Thanks for coming today. Hang in there. We're getting close to the end there. Get that cash flow out and work on it right away. You know what I'm talking about when we get here next time, okay? Pull those things up out on Moodle. Take a look at them. Get started.
Still got it? Oh, that's it.